Tortoises. Quality stocks are underperforming the most relative to the overall market since 1999. That means that companies with pristine balance sheets, with little debt, that can actually make money have never underperformed the most in aggregate relative to the overall index going back 25 years ago. Fuck's sake. Tortoises. Quality stocks are underperforming the most relative to the S&P 500 since 1999. This means that companies with pristine balance sheets that boost attractive growth rates, attractive margins, have never been trading at such a steep discount relative to the overall index going back 25 years. So the question that I have for you is, do you think this is going to persist, or are we on the verge of a significant slump in the market as a whole? So in this video, I'm going to tell you exactly what my opinion is. I'm going to tell you exactly what happened to Warren Buffett's portfolio back in 1999 at the peak of that tech bubble when he refused to jump into tech names because they were trading at nosebleed valuation levels. I'm going to tell you what this performance looked like in the years after the crash. And most importantly, I'm going to tell you exactly how I'm positioning the Leica Tortoise portfolio in our client's portfolio for the years ahead. The goal here, guys, is to set ourselves up for financial freedom with minimal risk. And the best strategy to do that is the one that we follow right here at Leica Tortoise. So, guys, if you are a busy professional and if you don't have a lot of time to commit towards your investments, but you believe that doubling your money every 3 to 4 years is worth at least 1 hour of your time per week, then this video is definitely for you. I'm going to break down everything that you need to know about our framework, and hopefully you will be able to implement this as well along your journey. So stick around. This is a jam-packed video. Make sure that you take notes. Yeah, let's jump right into it. All right, everybody. So let's discuss everything we need to know about the next few years and why exactly I believe that both value and quality investors are poised to make a lot of money in the years ahead, which is exactly the point that we are doing this. So more importantly as well, guys, don't forget, so everything that I will be walking you through today is mentioned in the free resource that you can get your hands on by going to the link in the description. Just make sure you download that free resource, and that covers the 4M investing framework that I will cover here, together with a few more insights into how I go about selecting companies. Right? So, and let me know as well if you found it useful, because from the bottom of my heart, I want you guys to do well, and I will make sure that I can provide as much free content as I possibly can. Because if you thrive, I know that our community will thrive in the other way around. So awesome. Let's discuss everything. By the way, many of you asked me to start giving some context on what I do as well. My name is Eduardo. I'm the founder of Like a Tortoise. We offer a coaching program. Namely, we help people on a one-to-one basis, which means that we only take on X amount of people on a given year. So we are always we have limited spots, exactly because to make sure that we can provide enough quality and make sure that we provide the most personalization as possible, then we cannot onboard many people. So if this interests you, just jump on a free advisory call with me as well, and we can see whether we can take your investing skills forward. Right, guys. So as far as quality investing is concerned, and by the way, at the time I'm doing this recording on June the 23rd, you can see right now that the S&P is down 1.5%, excuse me, 1.50%, while the Nasdaq is down almost 3% and still bleeding. I have no idea whether this is going to continue, but what I do know is that Ethereum, for example, is making new recent lows together with Bitcoin. The reason I'm naming both these currencies, both these cryptos, is because they typically lead the market to the upside, and they tend to lead the market to the downside. So they are the most speculative asset classes in the market. So when things are all rosy, it makes sense that people will prefer them over other assets because they tend to run faster. But they also so they take the elevator up and they take they take the stairs up and they take the escalator down, as we commonly say in business. And so just as fast as they go up, they also crash pretty fast than anything else I've seen. And that's what we are seeing right now. So I've been pounding the table on this for a few videos now, and I've been telling you guys, and everything that I mention here is based on data analysis, and because I devote a lot of my time doing a lot of due diligence in the sifting through data to make sound investment decisions and to help my clients as well. But I shared these two pictures with you not that long ago, and I will be starting this episode by sharing them once again. What you can see right here, just let me minimize my picture. What you can see right here, guys, you can see that quality stocks have been underperforming the most relative to the S&P 500 going back to 1999. All right. So what does that mean? Because quality, as you guys know, can mean different things to different people. But the way Bloomberg categorizes quality stocks, they are referring to stocks that, in other words, they are referring to companies that are profitable, companies that boost very good balance sheets. So they have little debt, they have a lot of cash, they boost attractive margins, good returns on capital. All of these things that many of you already know, these are part of that quality basket. And what we are seeing is that they are underperforming the most. And you can see that going back to 1995, typically quality stocks tend to outperform the market by a wide margin. And if you ask yourself, does that make sense? Duh, of course it does. Doesn't it make sense that companies that actually produce something, companies that are profitable, that have sustainable business models, well-established companies, doesn't make sense that these companies will continue to outperform over time? And the answer is yes. However, during periods of market euphoria, like the ones we are in, like the ones that we are in today, they tend to underperform because people are chasing the shiny objects. And by shiny object, I mean the likes of, for example, SpaceX. I have nothing against SpaceX. I'm just giving you an example. This is a company, ladies and gentlemen, that makes no money. You know, in fact, they are actually losing money because they operate at a 5 billion net at a 5 billion loss, and uh, they have after the retail investors plowed funds into the stock ever since they IPO'd just days ago. The company actually reached the status of one of the most valuable companies in the world, certainly by market capitalization, which is unheard of. A company that makes no money now can be compared with the likes of Amazon, Microsoft, Nvidia, all of which make a ton of profits. You cannot make this stuff up. And sure enough, when and now that the markets are down, I looked at what SpaceX was doing, and the stock is down like 17 or 20% over the last trading days, which is incredible, but at the same time not unexpectable. Hope that makes sense. So also, what I also want to share with you here is something that I shared with our community just yesterday. In looking at this picture, you can see that companies with negative earnings continue to outperform companies with positive earnings, exactly as I was describing a few seconds ago. And look how that gap has been widening since April 2025. You can see how this has been widening substantially since recently, and now that gap is the widest it's been since that period in time. So this is a red flag, if you ask me. It means that speculation is just out of the the speculation is completely through the roof. Let me put it that way. And in fact, I think I took a screenshot. These are very raw videos, guys. I don't have any editing, so I do all of this right on the go. And I think, yeah, this morning I took a screenshot that I really, really want to share with you guys here to drive this point home. So bear with me as I share this with you, because I just, yeah, I want to share this. And in fact, I'm going to share this with our community on WhatsApp as well. It's free to join if you want to join, but I have to do that. I mean, take a look at this. You cannot make this stuff up. So I have to go here, and I was reading this morning on Instagram. This is from Bloomberg, as you can see, and she says FOMO really got me. Taiwanese go into debt to invest in AI stock frenzy, and you can see right here in the description. Taiwan's locals are borrowing so much to invest in the TSMC fueled AI stock frenzy, it's raising fears of a bubble. Tap the link in bio for more. So this once again goes back to what I was telling you guys. It goes back to what I was telling you guys about the environment we are living through right now, which is absolutely unbelievable. When people go into debt to do stuff they have little knowledge of, that tells you everything that you need to know. So for this video, as always, I made sure that I put everything together in a PDF that I will walk you through shortly. And yeah, but once again, if you want to get your hands on something like that on the framework, just download it completely free. It's a link in the description. The only thing that you have to do is click that link, fill out the relevant data, and that is the free resource straight in your hands. Please let me know as well if you like that, if you found it valuable, if you will be using that resource going forward to make better investment decisions, because that means something. That means that what I provided makes sense, so that other people will be able to download it as well and make better investment decisions. So that would make my day. Right, guys, most people believe successful investing requires hours of research, constant market monitoring, and the ability to predict the future. In reality, we found the opposite to be true. The best investors focus only on a handful of high quality companies, make a few investment decisions each year, and allow time to do the heavy lifting. This is the exact framework we use to build concentrated portfolios designed to double in value every 3 to 4 years while keeping risk as low as possible. We want to make sure that we keep risk as low as possible, and not. And at the same time, we want to build a portfolio that we understand, and we want to devote as little time to those investments as we possibly can. And when you blend in, when you combine how can I say, all of these traits, then you are in a very favorable position, certainly compared to the overall market participants that track daily news, look at chart patterns on a daily basis, and that have a lot of stress, which leads to poor investment decisions. So step one, what you have to do is you have to build a watch list of great companies. And by the way, the reason I created this channel in the first place is because I was once a full-time worker. I had a 9 to 5 job. It made everything a lot more difficult to monitor as far as investment is concerned. And so not every strategy actually allowed me to go on and do my day job, but also to achieve the returns that I was hoping to achieve as an active investor, until I found the strategy that has been practiced over the last several decades, that was preached by Ben Graham and Warren Buffett. But I just added a few tweaks of my own to make sure that it aligned very well with who I am as an investor. Okay, and so what you need is exactly 1 hour per week. So the question I always ask is, do you think doubling money every 3 to 4 years is worth an hour of your time per week? And if the answer is yes, so this framework is definitely for you, because that was the position I was in and I still was able to do that. So can you. Before we think about stock prices, we focus on finding exceptional companies. We look for businesses that operate in industries we understand, have durable competitive advantages, generate strong cash flows, have predictable earnings, are led by outstanding management teams. We are talking about management teams that show integrity, that are shareholder oriented. These are the people that we want to trust our money with. Examples include businesses benefiting from network effects, strong brands, switching costs, cost advantages, scale advantages. The goal here is simple: the goal is to create a watch list of companies you would be happy to own for the next decade. Now, let me ask you this: do you think every company in the stock market will meet this criteria? And the answer is no. And there is a reason why this watch list of companies with all these traits is so important. Is because you want to make sure that more often than not, so you want to make sure that most of the time you will do nothing. You cannot do that with a mediocre business. A mediocre business will require a lot of your monitoring, because you constantly need to see if the company is taking on more debt, if they are making good investment decisions. Whereas a company that has been around for several years, in many cases decades, and they have managed to boost great returns on invested capital, good margins, and they have skin in the game, these companies don't require as much monitoring, which is why I prefer them over other type of businesses. And that's also why I don't understand in companies that operate in very cyclical industries. Okay? So that is the goal. Now, step number 2, pay attention to that. Apply the 4M framework. Over the last few years, I have invested a ton in my education, from online courses to books to newsletters to YouTube content, you name it. I've done it all. And I believe that the 4M framework, which is also preached and practiced by the guys at Rule Number One Investing, Phil Town, who is one of my idols. This works very, very well, and it's something that you can fit into your busy schedule. Every company must pass 4 tests, meaning, do you understand how the company makes money? Do you understand who their customers are? Do you understand the business model? Do you understand the geographic split? So how diversified or concentrated are they? You have to know the answers to these questions in order to understand the business. And if you cannot understand it in just a few minutes, then it's an easy pass, because some businesses have more complex business models than others, and the simpler the easier it is for you to understand, the more, how can I say, the easier it will be to actually stay up to date with that company. I hope that makes sense, because from the moment you decide to follow this framework, you will act not as a shareholder but as a business owner. And this is a complete mindset shift that really worked very well for me, and that I hope it works for you. So, would you be proud to own it? This is something that I implemented into the meaning, because if this is not a company that you would be happy to own outright, if you were given all the money in the world right now, then it's a pass. So one question that I always ask to my clients is, listen, would you put 50% of your hard-earned money into this company today if you were given the chance to? And if they say, well, I mean, if they start hesitating, then the answer is probably not. Is probably no. Does it fall within our circle of competence? Many of you already have jobs in different industries. Maybe you are in healthcare, maybe you are in IT, maybe you are in, I don't know, maybe you are in software, healthcare. Maybe you are in a consumer discretionary sector. I mean, whatever, right? Maybe you work at Walmart, well, at Tesco if you are in the UK, in which case you may know some of Tesco's competitors. The point that I'm trying to make is if you already work in a particular space, then chances are you have an edge relative to several other investors. And you can use that edge as you can work that edge to your advantage. This is something that Peter Lynch, one of the best investors of all time, has taught us. He told us that average retail investors can make better decisions compared to the smart money exactly because they have an edge. You can use that edge. For example, I know a lot of people in the sales space that work in the software space, and they told me if the SaaS apocalypse fears were overblown or not. They share their opinion based on what they see on a daily basis. So take that and use it to your advantage. Next, we have Moat. That is the second M. Does the company possess a durable competitive advantage? Can competitors realistically disrupt the business? Is the company likely to be stronger in 10 years than it is today? Before I decide to invest in a company, this is something that I have to understand. If I think the business is going to be in a better position in 5 or 10 years from now, then that is very, very good. Because what point would you, I mean, what else would you invest in a company if the business is not going to be around in 5 or 10 years? I mean, unless you are a trader without any regard for the company's fundamentals, in which case you shouldn't be watching this in the first place, then absolutely you should be thinking 5 and 10 years out. And you have to see, okay, so what makes this company unique? What are the customers saying about the company? So one of the things that I like to do is I see how employees rate the company and the CEO, as well as customers. What they say about the product or service. Do they rate them high? Do they rate them high or low? All of these pieces are part of the puzzle, and you have to make sense of them. Next, M, management. Are leaders acting like owners? Do they allocate capital intelligently? Are they transparent with shareholders? Do their incentives align with ours? One of the things that I always want, that I pay attention to, is I want to understand I want to understand the CEO. Ideally, the CEO would have been in place. So ideally, the CEO would have been at the helm of the company for several years, and he has built a large stake right into the company. And this means that if he has a lot of his wealth tied into the company, guess what that means? It means that he's a lot more prone to making long-term investment decisions that benefit shareholders as a whole instead of just his pockets. I hope that makes sense. However, if it's a relatively new CEO, make sure that you always check his track record. What has he done at previous companies? Has he or she managed to grow the company while working at that company? What's his track record? You have to understand these things. So I can give you some examples. We own Evolution AB. Evolution AB, skin in the game is quite high at that company. Over 20% of the company is owned by insiders. That is awesome. Okay, that is very, very positive. In addition, you have LVMH, Louis Vuitton. Louis Vuitton is a family-owned business. Over 50% of the company is owned by the family Bernard Arnault. Do you think they feel right? Do you think they feel the pain when the stock comes down 50 or 60%? I bet that they do. And this is exactly what you want, because this will make them more, once again, this will make their decisions aligned with ours, and they will feel the pain as much as we do. So try to stay away from companies with little skin in the game. One of the ones that we have, for example, is PayPal. But what you have to understand is that look at the current CEO's current compensation package, and you will see that he is very incentivized to drive the stock higher, the stock price higher over the next 3 to 5 years to make a lot of money, because that will bode very well for him as well. Now, margin of safety. Even a wonderful company can be a poor investment if purchased at the wrong price. We estimate intrinsic value and wait patiently for opportunities when the market offers a meaningful discount. So once we identify the intrinsic value of a company, then do we pay intrinsic value for the company? No, never. We never pay intrinsic value for the company. Why is that? Because the stock market is one of the only places in the world where you can find a great company trading at a big margin of safety. If you go to a car stand and if you try to buy a car, let's say you see the price tag and it says, I don't know, 500,000. And then you try to negotiate price with them and you say, listen, I want to buy this car at 50% off, right? 50% off. So I want to pay 250K for this car. What do you think he will say? He will call you crazy. Of course, you will never get your hands on the car. But in the stock market, because most people don't have the strategy that we do, so they prefer to make decisions over with a short-term outlook, right? Thinking in months instead of thinking in months, or just a few quarters instead of years. They are more susceptible to make a lot of trading instead of investing. And we want to take that and use it to our advantage, right? So I hope this makes sense. In addition, think about something that I always tell my clients. Guys, we have to account for the vicissitudes of life, as Charlie Munger said. No framework to calculate the company's intrinsic value is perfect, and we have to account for all the uncertainty that for all the uncertainty around that calculation. And the best way to do that is to demand a significant margin of safety, because our assumptions may be off. And if we don't have a margin of safety, then I mean, whatever, right? I mean, we can be, for example, instead of 150 that we calculated, the intrinsic value can be 100, just to give you an example. So it's exactly to make up for those, for that, for the fact that our calculations can be off, that we need to demand a margin of safety. And the same goes for the growth rates that you will project when calculating the intrinsic value of a company. I can show you. So for certain companies, especially if they are all related to semiconductors, some analysts, semiconductors are like the buzz of today, right? And so when you look at what analysts are projecting for these companies over the next 5 and 10 years, I mean, it's just mind-boggling. They are projecting 40% over the next 5 years, 40% earnings per share growth. 40%? Are you kidding me? These assumptions clearly don't account for any possible recessions that may happen over the next few years. So let them stay with their exuberant expectations, and make sure that you look at the company's track record. How much have they grown intrinsic value over the last, say, 10 years? And then try to make realistic expectations and try to build that into your framework. Okay, be conservative here as well. Now, step number 3, use a simple quality checklist. Before investing, we always review key financial metrics. While no metric tells the whole story, we generally favor businesses with, as you already know if you have been following the channel for a while, high returns on capital. Why? Why is this such an important metric? Because if the company has high returns on capital, it means that they can bring home more money relative to the one that they are investing into the business. Isn't that a great thing? Of course, it's a great thing. This is the recipe for long-term outperformance. Yes, because companies that boost high returns on invested capital tend to outperform the overall market over the long term. Consistent revenue growth. Does that make sense? A company needs to grow its revenues over time. That means that they are selling more of their stuff. If revenues are flat, do you think this is a red flag? The answer is absolutely. Not if it happens over a short period of time, but if you give me a chart of a company whose revenues have stayed flat for the next 5 or 10 years, I mean, yeah, that tells you something. Pay attention to that. It may be that the company is already look. You cannot expect a company like Apple, right, already so well established, so embedded everywhere, that continue to grow at 10 or 15% per year. However, if Apple's revenues don't stay flat for 4 or 5 years, which was the case, then maybe you should consider selling, especially if valuation is still very high. Just to give you an example, but we will cover some specific examples as well in this video. Healthy free cash flow generation. So we like to invest in companies that convert a lot of their earnings, a lot of their profits into cash. Think about companies that boost high cash conversion ratios. Typically, whenever you see this ratio above 100%, that's very positive. Strong balance sheets. I like to see all the companies that I put money into to be able to pay down all of their debt within 3 years of free cash flows. Within 3 years of free cash flows. This is very important, guys. Either they have within 3 years of free cash flows or within 3 years of net income. Not EBITDA or EBIT, no. 3 years of net income to be more conservative. And the reason for that is I want them to boost pristine balance sheets. In a high interest rate environment, it can be that these companies will, if they are borrowing money, if they have to borrow money at certain point in time, then they will have to pay a higher interest. They will have to pay higher interest payments on the debt, and unless they have good balance sheets, they won't be able to live on that debt. So they won't be able to continue to perform well without facing risks of I don't know, for example, bankruptcy in certain scenarios. All right. So I like to see pristine balance sheets, and typically that means a lot of cash on the balance, a lot of cash on the balance sheet, and also lower debt levels. Predictable profit margins. Let me just take a sip right here. I always get so excited when recording these videos. Right. So predictable profit margins. Why is this important? Because margins are a percentage of revenue. So the more the company can convert, the more the company can convert, the bigger portion of revenue that is converted into net income, the better, right? It means that you are talking about a very profitable company. And what happens is, for the company to boost predictable profit margins, then they have to have some kind of moat, especially if it's a company whose profit margins have hovered, say, 10 or 15% over the last 5 or 10 years. They must have something, right? Because that is not common. Not every company can boost this type of metrics over very long periods of time, and we want to see that. In addition, think about it this way: one of the reasons we invested into Lululemon is because they boosted the best profit margins in the space. And right now, look how important that has been for the company. While several companies in that space, in the apparel space, are struggling because they already went into, because of all the tariff headwinds, they had to absorb a lot of those costs and pass them on to the customers. But they also had to absorb a lot of those costs. And because they went into this crisis with operating with thinner margins, they risk going bankrupt. Whereas a company like Lululemon, which already boosted much higher profit margins compared to the overall industry, they can absorb a lot of that impact and actually consolidate while consolidate when a lot of the competitors go under. And there are so many pressures right now. You have tariffs, you have war happening in Europe as well. All of these things can impact are impacting consumer discretionary spending, as you know, not least because we have inflation, and not many companies can absorb these costs without significantly eroding their balance sheets. Many of them will have no other option but to either dilute existing shareholders or take on debt. Use a simple low debt relative to earnings, we already discussed that. The goal is to identify companies that can compound shareholder wealth for many years. Estimate intrinsic value. And by the way, if you are looking at this thinking, oh my God, Ed, but how is that only 1 hour per week? Yes, it is, because today you have what we call stock screeners. So what you have to do is to input certain criteria, certain parameters, and I share every single parameter that I use. So I'm talking about, for example, profit margin being over 20%, revenues being over 10%. I share all of the metrics in detail that I use in the free resource that you can download as well. Once again, it's right in the description. And once you run that through a stock screener, it will shortlist a list of companies that meet all of these quality criteria. So make use of it, guys. It's free. Step 4, estimate intrinsic value. This is where patience becomes an advantage. Rather than thinking, will the stock go up next month? We ask, what is this business worth? We estimate a range of intrinsic values and compare it with today's share price. Only when the discount is attractive enough do we consider investing. If it's not attractive enough, we do what we typically do. We keep all of them like on the watch lists. We have the intrinsic values calculated for each of them with the margin of safety entry price, and then we wait. We wait either for a company specific event to crash the company or a macro event like a recession, right? To crash the entire market and those companies with it. Step number 5, build a concentrated portfolio. I don't believe in diversification. Now, guys, I understand not all of us have the same risk profile or the same temperament. I understand. I don't think I will ever invest more than I don't think I will ever have more than 8 or 10 companies in my portfolio at any given point in time. And the reason for that is because I like to understand what I own very well. I'm passionate about business. I'm passionate about investing. I like to dissect every company before putting my money into them. And there are only so many companies that I can understand without diluting without spreading myself out too thin. Number one, and without losing track of what I own. So diversification protects against ignorance. Concentration rewards knowledge. Once a company passes our process, we build meaningful positions in our highest conviction ideas. Rather than owning dozens of average businesses, we focus on a smaller number of exceptional opportunities. Step number 6, review the portfolio for 1 hour per week. Our weekly routine is deliberately simple. We review earnings reports, company news, portfolio allocations, valuation updates. Most weeks, no action is required. The purpose of investing is not activity. The purpose is results. I keep telling you this. The only times you need to check in with the company is when they report earnings or when there is a headline news that is actually warrant your time. And it's not every news like, oh, Lululemon, for example, Lululemon said this, or sales in China are slowing down by 1%. That is not significant headlines. A significant headline is the CEO got fired. For example, this morning I was going through the news, and I saw that the CEO of Domino's was stepping down. If you are a shareholder in Domino's, this is something that you should pay attention to. Okay, so who's the guy who has the board appointed to replace him, right? Is a guy at the has the guy been working with the company for a long time, or are they bringing in someone from outside? This is important. It's worth your time. So our weekly routine is this one, as you can see. In step number 7, let time do the heavy lifting. This is where most investors fail. They interrupt the compounding process by chasing trends, reacting emotionally, right? So, for example, they see the stock coming down sharply, they automatically assume that the market is right while they are wrong, and then they try to shift the narrative and they say, oh, the story has changed. No, it has not. No, I mean, most often than not, the story has not changed. The problems are the same, but the market only becomes more pessimistic. Trading too frequently, trying to predict the market, we focus on allowing great businesses to compound value over many years. Patience is often the highest return activity available to shareholders. The goal, once again, the objective is not to beat the market next week or next month. Guys, I've been very transparent about this. The Leica Tortoise portfolio has been underperforming this year. We killed it in 2025. We, like many other investors, certainly in the quality space, have been underperforming this year. Does that upset me? Absolutely not. Because would you rather underperform 1 out of 3 years or 3 years out of 1 year? There is your answer. So I expect us to underperform once every 3 years. More often than not, we will outperform and we will get our doubles every 3 to 4 years. So the objective is to build a portfolio of outstanding companies that compound wealth over decades and that allow you to sleep well at night. And that is the case with our portfolio right now because our companies boost better metrics relative to the overall market, and they also are trading at much lower valuations compared to the overall markets. This is the combination that will set ourselves up for financial freedom and for significant outperformance over time. That's how ordinary professionals can achieve extraordinary financial outcomes while spending as little as 1 focused hour per week managing their investments. Simple, repeatable, scalable, like a tortoise, and designed for real life. And so, to give you some examples of these, um, first of all, I mean, I don't think, yeah. So I just to give you some examples. Let's have a look at. I already gave you some examples of the companies that we own. For example, Lululemon, PayPal, Evolution, LVMH. All of those companies met that criteria. If I go right here to LVMH, you can see that we were. I think the line is still drawn on the chart. Yes, it is. Don't ask me whether I picked the bottom. I didn't. I'm not in the business of catching bottoms or of predicting what the bottoms will be. I'm in the business of buying great businesses at margin of safety prices. And that was the case with LVMH. Look, due to tariffs, inflation, the clash between China and US, this company, the market crashed the company about 50%. And you can see that the blue line that you see right here is where I started my position. And I started my position right here around June 2025. It met all the quality criteria and the big margin of safety. Sure enough, the company then went on to achieve a price of 657 before giving back all of the gains. And now here we are range bounding right here. So I haven't sold a single share because, per my understanding, the intrinsic value is much higher than 652, and so I'm not selling any shares until that full intrinsic value level is realized. Okay, that is when the gap between value and price is closed, and if the price gets there without fundamentals changing, I'm selling the stock. Another company, for example, is let's talk about Novo Nordisk. This is a company that several of my clients have bought with a huge margin of safety, and some of them, many of them, I must say, are already in the money. You may think, but how is that possible? Look at this crash. Guys, price is what you pay, value is what you get. If you were buying the company, if you were buying the company without any regard for its intrinsic value or without accounting for any headwinds that could happen in the years ahead, then you are probably sitting on substantial unrealized losses. But some of my clients bought the company around 376, so they are still down, but they are still down. However, the intrinsic value is significantly higher than that. They have already priced. They already had factored in a lot of headwinds into their calculations, and so they bought with a big margin of safety. And some of them bought even lower, around 228, 245, which means that they are already in the money. And this is a company that is a duopoly, is not going to go anywhere. There will always be demand for what they are selling, and so again, I'm very convinced that they will continue to make a lot of money in these investments. Everything that we do here is for financial education. It should not be taken as stock picks. Okay, so make sure that you always do your own due diligence. But another company, for example, is let me give you the example. Let's talk about Alibaba. I know many of you love Alibaba. I haven't sold a single share in this company, and you can see, because I made it very clear, that my cost basis on the company is around 74, right here. 74. At one point, the stock ran up from 74, as you can see, all the way to almost $200 a share. And I haven't sold a single share because it didn't reach the intrinsic value that I had calculated. And again, that's totally fine, because ultimately I'm not selling any shares until the market reprices the company back to its real value. And this is what you should do. Again, most of the time you will do nothing. You will do your due diligence prior to buying companies, and most of the time you will just need to monitor them on a quarterly basis. That's it. On average, that is about 1 hour per week to double money every 3 to 4 years, guys. So still the process that I use. Let me know in the comments below if you liked it. And the goal is to provide as much value as I possibly can. And let me know if I'm doing that, guys. Thank you so much. I hope you like this video. Smash it and be a tortoise.